All right, so that's the cost approach. There's a third approach called the income approach. In your book, on page 306, I want you to write, actually it's 307, income approach is good for investment properties. All right, like a commercial strip center. All right, commercial strip center. This is based on the principle that a property is worth is based on the income it can generate. All right? To me, investors ought to be in this commercial world, in my opinion. Because you can take a building that's vacant that may be worth $100,000, fill it up overnight, it now has tenants in it, could be worth $800,000 or $900,000 in a couple of weeks. Never in the real world will a house appreciate that fast. But commercial will because it's based on the income it generates. Before we get into the value, I have to do a little accounting with you, and I want you guys to follow me on some accounting general formula so you understand what we're getting at. Okay? Those of you at home, follow along. Gross operating income. Gross operating income would be all of the income that a property can generate. Name some income types a property could generate. What's the most notable one? Rent. Now, remember, we're not thinking just necessarily houses. What's some other income? Do what?
Farmland rental.
That's still rent. Come on, you guys, any of you guys lived in an apartment complex before?
Parking spaces.
You have to pay for a parking garage, maybe. You want the covered or the garage or just park on the street? So you got parking income. What? No, not condo fees. That's not rent. What about laundry? Did you go down and pay for the laundry? Put the quarters in? How about Coke machine? Swimming past park pools? Rent the clubhouse? All of those are different kinds of incomes that could come from investment property. All of those would go into the gross operating income. I want all of the income that could be generated. Late fees. That's another one. From the gross operating income, I want expenses subtracted. Name an expense.
Referral fees, paying somebody for a referral for an apartment or something.
Okay, if an apartment pays out a referral fee, that would be one. Utilities. Doesn't the tenant normally pay for utilities? Maybe on the common area, I don't know, like the office. Lawn care, to run the pool, maintenance. All of those would be captured as an expense. What is not as an expense is the house payment, the mortgage payment. They also call it debt service. That's the very fun commercial world. Why? Because an expense is required. I got lawn care, I got taxes, but I don't have to have a mortgage. So it does not count as an expense. Mortgage payment or debt service does not count as an expense. I would subtract out my lawyer fees, my advertising fees, my maintenance fees, my referral fees, cost to run the pool, cost to run the putt-putt course, whatever I've got, that's all an expense. If I subtract my expenses from my gross operating income, I get this thing called net operating income. Now, look at this. This accounting is typical throughout the whole business world. Those of you that have a JOB, you get your gross pay, right? Well, you got hourly pay, and I got some vacation pay, and we got a bonus. So all of the pay goes into your gross pay. Everybody get what I'm saying yet? Overtime, payroll, bonus, vacation, whatever it is. Then from that gross pay, what are they going to do? subtract expenses, taxes, your health care payment, whatever, and you walk home with your net pay. So it's the same concept. Gross pay minus expenses equals net pay. From the net pay, now you subtract your house payment. You go home and pay your house payment. It's called debt service. When you subtract debt service for net operating income, you get cash flow. It's a common accounting equation. Gross pay less my expenses is my net pay. You guys call that take home. From your take home pay or your net, you go and pay your debt service, i.e. your house payment, and what's left is the cash in your pocket. That's cash flow. It's important you understand that concept because the income valuation is based on this concept. The appraiser uses two very common methods to do this. The first one is called the cap rate. Cap rate, which stands for capitalization rate. The cap rate, think of it like a return on your investment. If you went to the bank and you said, I've got $100,000, I want to buy a certificate of deposit, a CD. And you say, how much is your CD paying? And they say 2%. That's a cap rate. That's the return. You're going to make 2% on that money. All right? Appraisers will use a cap rate to determine value because the equation you need to understand is net operating income divided by cap rate equals value. You better know it, learn it, love it. Net operating income divided by the cap rate equals the value of the property. So your first question to me is, well, where do they get a cap rate? This is where the appraiser is trained. Now, when you're doing this kind of appraisal, I told you a minute ago, this guy's probably got hundreds of thousands of hours in and it's 20 years, and he knows what a cap rate is. On the test, they will be given to you using a cap rate of 8. You're not going to have to determine, well, it's a multi-tenant in the Midwest, non-franchised, 3 years on the lease. Oh, that's a 6.4. No, you won't have to worry about that. It'll tell you using an 8 cap rate. The appraiser will worry about that. That's where his expertise comes in. He's going to tell you on a small mom and pop strip center with non-anchored, meaning no national tenant, in the Midwest might be a 6.5. All right? So let's do a math example. Very fun to do. If there are, let's say there are 5 units, each one's paying $500 a month, $500 a month in rent. The expenses are $10,000 a year. And the cap rate is 8%, and the appraiser knows that. Assuming all those are true, please tell me the value of this property. 5 unit. Each unit's paying $500 a month. The expenses are $10,000. The appraiser knows it's a cap rate of 8%. What does the appraiser's value come out to be? I don't know. I think I've done this problem before. What's the first thing we need to figure out? What's a cap rate tell? Well, what do we need first? We need the net operating income. I gave it to you indirectly. You got to use the formula. So what's the gross operating income? Somebody tell me what the gross operating income is. $30,000. How'd you get that?
5 times 5 times 12.
Right, because remember that I told you it's $500 a month. So it's 5 units times $500 a month times 12 months gives you the gross income of $30,000. But we don't want the gross. We need the net operating income when dealing with a cap rate scenario. So how do I get net operating income? I subtract the expenses of 10 grand. That means my net operating income is $20,000, 30,000 minus 10. Now I just, like my math professor used to say, plug and chug. Net operating income is 20,000 divided by 8%. What's 8% in the decimal? 0.08 tells you the value of this property is $250,000. 250. So the appraisal will say, based on that income, it's $250,000. Literally, the math is that simple. The hard part becomes for the appraiser, proving the income, proving the expenses, all of this. And this is where I love when people, my favorite saying is, you ever heard of, you live by the sword, you die by the sword? This is where they get killed. Oh, well, I really made $600 a month, but I didn't turn it into the IRS. Dude, you cheated the IRS, and now you're cheating yourself because I can't claim 600. I got to claim 500. That's what you claim to the IRS. I've been involved in many bars on both sides of the bar, as a matter of fact. But when you're behind a bar, that seems to be a big thing. Oh, yeah, we made cash and didn't report it to the IRS. Now they want to go sell it. And you're like, yeah, you reported 20 grand. I made 400. You didn't report it. I can't use it. All right? So it's really that simple when dealing with the cap rate. Net operating divided by cap equals value. Okay? Are we good? Now you need to understand, are you guys algebraically inclined enough to realize that that equation has 3 set types of equations? Because I could also ask you, here's the net operating income. The appraiser said it's $250,000. How much is the cap rate? So you would take net operating income divided by value equals net or cap rate. Tell you it's 8%. So you can algebraically change around that equation 3 different ways. I could also ask you, what's the net income? Well, the value is $250,000. The cap is 0.08. 0.08 times 250 is 20 grand. That's the net operating income. So be prepared for that just because I showed you that one doesn't mean I might not ask you another one. Okay? There's the cap rate example. What's the value of the property using the cap rate example? It's there on the screen now. That would be $250,000. Now, there is a second way to judge property's value. It's called the gross rent multiplier. A lot of times you hear it called the GRM. The cap rate, remember I explained it to you? It was like a return on your investment for a CD. The gross rent multiplier, I can explain it to you, but then I'd have to kill you. No, I don't get it because I don't use it. Gross rent multipliers are typically used on large apartment complexes. Large apartment complexes. Okay? So in an example of a gross rent multiplier, you literally do exactly what it says. You use a gross rent multiplier. Okay? It uses only the rents, not the net income, the gross income.
Does, you know when you search Zillow or one of those apps, realtors.com, they have the rent for this would be kind of the equation on their sites, where they give you this properties for sale for 150, but if you were to rent it, this is the approximate cost of what the rent would be. Is this all what they factor that on?
I don't know. I don't know what you're... Yeah, I don't know what you're talking about with Zillow. This is all commercial property. To my imagination, Zillow doesn't do anything with that. They're all residential. Are they trying to? I don't know. This would be used by an appraiser who literally would sit down with the owner and say, I need your Schedule E income for your building. How much did you claim on taxes? How much did you claim in income? All of that. And let's go through and pull some of this stuff out and do it. And that's why I was saying you live by the sword, you die by the sword. The owner of the property charged $800 a month in rent and asked everybody to pay cash, but he only claimed $600 on the IRS form. The appraiser is going to go, I need the IRS form. What'd you show the government? Oh, but I made more. I can't use it. You didn't claim it, so you didn't pay taxes. So he literally would ask for this kind of stuff. And when you get into investing in this kind of realm as an investor, this is stuff we would do. Okay, we want to see your Schedule E for that property. We want to see the expenses you claimed. We want all of this information to verify. The math literally is that quick. It's verifying the numbers that becomes the hard part. Because you've got to verify where that guy claimed, and I've seen all kinds of weird crap. You know, where an investor had 4 houses and he put them all on one Schedule E. Now you got to break out the income for that one house. It's hard to do. You know, you're supposed to have a Schedule E for each investment property. All right? There's a second one called the gross rent multiplier. It's exactly what it sounds like it is. It's the gross rents multiplier. Okay? So for an example, if I told you the gross rent multiplier was 25, and it had 5 units paying $12,000 a year and collects another $5,000 in income. You guys have the overhead on your sheet, you're on the screen, people at home looking at it. 25 is the gross rent multiplier. They will give it to you again. Once again, you don't have the ability to do that. If there are 5 units paying $12,000 a year in rent, but it also collects another $5,000 in other income, I don't care. It doesn't matter. I could add all the income up. Pool passes, late fees, parking stickers, all that. Just add them up. All right? Because here's what I'm telling you. If the gross rent multiplier is 25, literally take the gross rents. What's the gross rent? 5 times $12,000? $60,000. Doesn't matter what the expenses are because the gross rent multiplier is not using net numbers, it's using gross numbers. Then you would literally take that 60,000 times 25, $1.5 million. Notice what I did not add into that. Well, I didn't add the expenses because it's gross. But what else did I not add in? Other income. It's a gross rent multiplier. Now, for those of you that like to look ahead, guess what? They also have a gross income multiplier. Because the income it generates also has some value. Typically, rule of thumb, 4 or less uses gross rent multipliers. Because there's typically on a fourplex not a lot of other income but you can start getting into a 600 unit apartment complex, there's a whole bunch of other income. So you want to capture that value, so they use this other thing called a gross income multiplier, a GIM. So if the gross income multiplier is 25, if we use the same property, now we've got 5 times 12 is the 60,000, right? That's the rent. But you've also got 5 more thousand of other income, so you would add it together. So now you have $65,000 of income. 65 times the 25 turns out to be $1.625 million of value. So be careful what they're asking for. Gross rent multiplier or gross income multiplier? 65 is 5,000 or is $12,000 a unit times 5 units, right? That's 60 grand. But it also had 5,000 of other income, so you add that income to that income. So I get the total gross income now, 60,000 in rent, 5,000 in other stuff, late fees, parking pass, pool pass, makes a total income of 65 grand. Are we good with these? So just watch out. Cap rate uses net. Gross rents and gross income uses gross. And they're literally exactly what they say they are. If you listen, say gross rent multiplier. Gross income multiplier. Are we good?